Howdy there, folks. Welcome into today's video. Two videos for me to react to in this one. It's buy one, get one free. Okay, first one up here, Tom Lee, Fun Strats Tom Lee, everybody's favorite bull, is not a bullish on the next 2 to 3 weeks in the stock market. So I want to react to this one. CNBC titled this video wrong, by the way. It has nothing to do with 2024. Okay, the whole discussion is about what's going on over this next few weeks and why I can hold back the market and actually have the market have a painful drop as he describes it. Okay. Second video I want to react to is expect recession around year end. So I want to react to this one, kind of give my perspective and opinion. So it's a double dose of bearishness in today's video. One short term, one a little later this year. Hey man, I'll take all the bearishness we can get, which by the way, look at this folks. I am outside recording a video in August. It is August 1st here today, right? I will take this, man. It's like 87 degrees out. A little humid because we did a little rain here in Vegas this morning, which, by the way, I will take that. But, yeah, if you can be in the middle of the afternoon, like I'm recording this one, and it's 80-something degrees, August 1st, we'll take that every single day here in Vegas, baby. Give me that weather. So, yeah, happy to provide this video for you guys here today, give some perspectives and opinions. Thanks for being here. 32,000 plus subscribers. You got to be flipping my flapjacks. We just hit a new record. So I appreciate every single person subscribe to the channel. That's just crazy, man. Alrighty, let's get into this.
Conversation with Fundstrat co-founder and head of research, Tom Lee. Tom, great to have you with us. You're also in the camp that August could be tricky.
Yes, yeah, I think August is tricky because, as Bob mentioned, people are on vacation, so it's more vulnerable to sort of shocks. And
people are on vacation. These damn Wall Streeters, they go on vacation all summer. I mean, in July, their 4th of July holidays are away for a few weeks. August, they're on vacation. Is there any time they're not on vacation? My goodness.
I think
then November, December, they're on vacation. Santa Claus rally, like it's just permanent vacation, man.
We're in a period where we're going to be nervous about good news. We don't want a good jobs report, or we don't want strong PMIs because that brings September hike back on the table, along with the 10-year where it is. I think it's very possible we could have a pretty painful drawdown in the first half.
You've been bullish when others have not been.
Yes.
Through the first half.
He says painful drawdown the first few weeks here of August. Interesting.
And now that you see strategists sort of bumping up their price targets for year end, Bob was...
Okay, before we go further, what do I think about that? So my perspective and opinion on that is, I think he's right if one specific thing happens. Okay, one very specific thing. That one specific thing is if Apple reports really bad numbers on Thursday. Okay, if I recall, Thursday after the bell, Amazon and Apple are both reporting. If Apple specifically has bad numbers, bad earnings, bad guidance, anything like that, right? That would be the thing that sends this market down quite substantially over the next couple weeks. Let's just call it that, okay? Outside of this scenario, it's actually hard for me to see a painful drop. 1-2% drop in the SP 500 is nothing. Painful is really like a 5, 7, 10% drop in a matter of a couple weeks. That's painful, right? Because then you're talking about a lot of stocks go down 10, 20, 30%. But we need Apple to basically report really bad earnings. That would pull all the semiconductor stocks. That would pull the entire Qs down. We know Apple's a $3 trillion+ market cap, right? So I will say Apple's setting up for potential downside going into earnings. That stock's been running. The valuation is very rich. They're going to need to come in with great numbers to keep things going. If things aren't great, then we could be talking about a downward draft, which would be a nice kind of breather in the market and a nice kind of buying opportunity for a lot of folks that just have felt like, I don't want to buy because it seems like we're just keep roaring higher and higher and higher, right? If we could get kind of that painful drop. But that's what it's all predicated upon right now, okay? The Fed, they're not making a decision for another, probably month and a half to 2 months. So the Fed's still a while away. No CPI report until I think the 13th or so. So all eyes are going to be on Apple in terms of moving this market up or down.
About the extreme bullishness now, does that make you just worry?
Yeah, I think it's a bad sign.
Yeah.
I think we know the strategists tend to reflect the buy side, and all these price target hikes are chases of a market that's already extended. And then we have August, which is seasonally kind of bumpy, and I am kind of worried that we're going to get some good jobs data, like strong job numbers. People are going to start thinking September and higher rates. Oil's already rising. It feels like it could be pretty messy.
So how do you see the path of the markets going into the fall?
So it's a possibility, but obviously the Fed doesn't just look at jobs data. They're also going to be looking at CPI heavy and all the other inflation metrics. And based upon what I see, I look at the trueflation numbers on a daily basis, and the trueflation numbers seem to kind of lag a month or two versus like the government numbers. And we've been in the twos comfortably, in low twos for almost this entire past 30 to 45 days, which means likely government numbers are going to be probably in the high twos come this upcoming month. And so I think that could take everybody by surprise, because then, where's the Fed want us? The Fed wants us in the twos for CPI, and then if all somewhere in the twos, then if anything, people start talking about, okay, the Fed is done now. The Fed will not raise any more outside of, CPI starting to go up again to 3s and 4s or something like that, right?
Traditionally, seasonally, a difficult period, particularly September, October.
Yeah, I'm sorry. All these things I mentioned are just tactical, because I think the second half is going to be really strong. But to me, it's a broadening.
Okay, so right there, if you only watch the first minute of this, you're like, man, is Tom Lee bearish? And he says, whoa, hold your horses, okay? Flip a flapjack or something. I am still bullish for the remainder of this year, he's saying here, okay? He says, I think the next 2 to 3 weeks could be a little scary, but in terms of the remainder of the year, he's obviously still very bullish.
Particularly September, October.
Yeah, I'm sorry. All these things I mentioned are just tactical, because I think the second half is going to be really strong. But to me, it's really a broadening of the market. It's more about the industrials really responding to the PMI's bottoming, and it's energy reflecting the rise in oil. And so I think it's a broader market, but we could still finish, over 4,800, well above it on the S&P.
I mean, we're seeing that today with Caterpillar and Eaton.
Could still finish 4,800 S&P or well above it, he says. I think that's an important line there, well above it.
But we could still finish, over 4,800, well above it on the S&P.
I mean, we're seeing that today with Caterpillar and Eaton, for example, advancing. That said, Bob just raised that idea of a sort of a valuation ceiling, and the fact that we may be hitting or bumping against it in terms of where PEs are, based at least on the earnings we've gotten so far. Do you worry about overall valuation levels?
Yeah. The reason I'm less worried about valuation is so many clients tell us valuation's a problem. And so when you know that that's already top of mind for clients and they're already being selective, I think the valuation problem tends to be in the mega cap, and the, X the top FANG, we're at 16 times. That's pretty reasonable for a 4% 10-year. So I think
you're just taking out, although Meta, frankly, trades below many of the others, but you're taking out some of the big guys, and then you get down to 16. Is that a way to justify it, or is it still?
That's how our clients pick stocks, right? Because they don't have to buy the FANGs.
They don't? Really? Don't they all just chase?
If you're indexing, right?
Yeah.
If that's your comparison.
That's right. And then if someone's making a case for FANG, imagine someone's thesis is don't buy it because it's expensive. That you would have avoided it for 20 years. So you can't take FANG and say that's a reason not to own it because it's expensive. They've always been. But the rest of the market is pretty reasonable.
That reminds me of the story. I don't know if I told you guys this. Well, I know I've certainly told this story before on YouTube, but I've been on YouTube like 100 freaking years. So I don't know, where people have been following me and what stories they've heard over time. But I remember, being probably around 2010, 2011, and I took a real look at Amazon stock because I was pretty interested in Amazon stock, okay? And, I liked everything that was going on in their business model. I was like, this e-commerce thing, this is just going to grow massively bigger. They're prime position for that. And I remember taking a peek at Amazon, right? And I remember, especially back then, I didn't really know how to value growth stocks because I was still somewhat newer to the market, right? I was in my first few years of investing, and, I didn't have somebody to teach me and hold my hand. So I got in the market 08, 09. I had to pretty much teach myself everything, right? This is way before, all the resources people have today, right? So I had to learn everything trial and error. I didn't really know how to value growth stocks back then. I just knew P metrics, and if it was over a 20 P, don't even talk to me. Even over a 15, I want P's really, really low. So Amazon traded, obviously, even back then, very, very rich in terms of P metrics and things like that, right? So I could never buy Amazon just based upon the fact that it looked like it traded rich. All along, Amazon was actually trading extremely cheap. But back then, I didn't know how to value growth stocks, right? And obviously, over the past, 12, 13 years, whatever, Amazon's gone up 2,000+%, right? And that's why, you got to learn all these different disciplines because you don't value a growth stock the same way you value. This is the one, if you guys want just a gem for me to drop here, here's a gem for you, okay? You do not value a growth stock the same way you would value a value stock. or a dividend stock. This is a cardinal sin a lot of value investors make because they're never able to buy any growth stocks. You have to look at what are likely future growth rates for a company. Then you have to back that out and say, okay, based upon where this company's EPS will likely be in 2 years from now, 3 years from now, 4 years from now, this is actually, I'm stealing money buying the stock here today, okay? Because based upon the valuation I'm paying today, based upon where I think this EPS is going to be in 3 years from now, this is actually a great steal. If that makes sense on a 3-year basis, then we're talking. Then we can make a move on that. The problem is, value investors many times look at a stock and they say, that stock's trading at a 60 PE. It's overvalued. It's a ripoff. What are the growth rates expected? What's the revenue growth expected? What's the EPS expected? Okay. What are your numbers you're expecting for this business model over the next few years? Just because a company says 60 PE today, or a 10 price to sales ratio, or a 20 price to sales ratio, it's all irrelevant. Where's the company's EPS in 3 years from now? You tell me that, and I can tell you where that company deserves to be valued today and where it deserves to be valued 3 years from now, okay? Very, very important. If it didn't hit you, okay, watch that 1 minute clip back again because it's very, very important. All righty, let's get back into this.
I think there's a reason to own both.
But if valuation is not a worry, then 4% shouldn't be a worry either.
It's not. It puts stress in people's minds, but you're absolutely right. You know, the 10-year averaged 5.3% from 1990 to 2007, and the market's total PE was 18 times. We're at 16 times ex-FANGs.
That's important. That's so important. Let's listen to that again. That's super, super important.
Percent shouldn't be a worry either.
It's not. It puts stress in people's minds, but you're absolutely right. You know, the 10-year averaged 5.3% from 1990 to 2007.
1990 to 2007, the 10-year average 5.3.
And the market's total PE was 18 times.
And the market's total PE was 18 times. That's very, very valuable there because right now 10-year 4 something.
We're at 16 times ex-FANG, so there's still room for plenty of multiple expansion. And, you know, it's a good...
So we're trading lower today if you X out FANG, and when you take into account that the 10-year is actually lower than it was during that time period. That's very interesting.
For companies when the bogey's 4% on 10-year because it also limits competition, right? Capital formation slows, so the dominant companies actually make more money.
That's a good point. That's a good point as well. And, you know, the nice thing for stocks so far this year, and I think this has been a tailwind for stocks and no one's talked about. I haven't heard anybody speak of this. And I think it's been a huge tailwind for a lot of the public companies out there, okay? This year, almost no one has gone public, right? So the way I look at this is if you have a ton of companies going public, you have all these different companies stealing money from other opportunities, right? Because some companies goes public and people sell out of other stocks to put that money in that new stock that just went IPO, right? We haven't had to deal with that this entire year. Look at how many IPOs has been this year. Look at how many SPACs has been. Hardly any, right? Now, if the market stays in a good place in the back half of this year, then I can tell you 2024 will shape up with a lot more IPOs and a lot more SPACs, and we will have a lot more competition for stocks, a lot more stealing money around, okay? And so that is just something important to kind of keep in mind there, folks, okay? All right, next one up here, expect recession around year end, says JP Morgan's Bob Mitchell. Let's hear what he has to say.
Let's get right to it, Bob. And you are not fully persuaded by this little breakout today, are you?
Not really. I think the market's concerned that perhaps inflation isn't as low as the Fed would like to see it. Even though there's been disinflation, it's coming down. Growth is slowing. Markets get concerned that the Fed may have to come back and keep hiking rates. We heard that from Kathy just a few minutes ago.
But it sounds like the market also thinks the Fed is done.
Kathy,
so
what?
here's the thing. On a day like today, purely technical, right? We get the worse than expected data. We don't suddenly have them pricing in, a September hike or anything like that. So why are yields jumping? And then everyone's saying, well, it's just a supply issue. There's going to be, trillions of supply coming down the pike. Okay, fine. But why today? Why is this pushing, everything higher today?
Well, there's a lot of technical movement in the market today. CTAs are pushing the market lower. There's been some selling. They're forcing yields up. We tend to just want to look through that. We want to concentrate on the data. That shows things are slowing down. I know you just talked about ISM But the one component of the ISM that we spent a lot of time talking about was employment. It continues to decline. You've only seen it at these levels when the Fed has been cutting rates. So either this is something brand new, or the markets, the data in the markets, the economy is telling us we're going to see slowdown.
So you're in the recession and the lower bond yields camp.
Absolutely.
Okay, 10-year level, next move from here. Well, maybe I shouldn't ask you next move, because at this point, who knows? But what's the ultimate move, do you think, in the next 12 months or so?
We see the U.S. in recession somewhere around year end. We see the Fed cutting rates before then. We think they'll have to go down to 2.5% to 3%. We see the yield curve pretty steep. We can see the entire yield curve, say 6 to 9 months from now, 3%.
Interesting. Okay, I wanted to set up Rich Bernstein with all of that said. So Rich, and I know you've been more constructive in kind of saying, everyone's been calling for recession. It's not here. But have people now gotten so bullish it's making you bearish?
Before we go further here, how do I feel about recession at year end? Okay, I'll tell you this. I think it is very tough to get recession at year end. I don't think it's impossible, but I think it's very tough. Remember, there's only 5 months left in the year, right? It looks like we're coming out of a goods recession now at this point in time. And if anything, the goods side of the economy should actually strengthen in the back half of this year, which is going to be a very interesting dynamic, right? So you have that at play. You also have the fact that all this construction work is still going on, right? You have massive amounts of job openings. So to get huge job losses look more and more unrealistic. It looked a lot more realistic at the beginning of this year. Now, as we've ticked along this year, it's looking more and more unrealistic about any sort of big job cuts now at this point in time. So if anything, the job market actually is probably looking a little better than it was at the beginning of the year, which is a very interesting dynamic. So I think it's a safer bet. If you're going to bet recession, I think it's a safer bet for 2024. I think to try to get this a recession in the next 5 months is going to be very difficult, because I think there's definitely a real possibility of reacceleration of the economy, if anything, over this next 5 months, especially when I look at consumer sentiment. Real wages are finally going up again. That's been a long time since that happened, right? So if anything, that should help at least a little bit here. Student loan repayments could be away, but that's obviously really more toward like October timeframe in terms of that starting to kick in, and that could be more of a negative effect more for 2024 than the end of this year. So there's a lot of dynamics here. I think it's a tough bet to bet recession this year. I think it's a much easier bet to bet recession next year, and even next year is still not a guarantee. But I just think if you're going to place one way or another, I would put it toward next year rather than the next 5 months.
No, Kelly, I wouldn't say that. I think to some extent the focus on the ISMs, one has to be a little bit careful right now. Remember, the ISM is just a diffusion index, and it basically asks the question, are things better or worse? So when we were in a pandemic, of course, everybody answered it's better. It's not going to get worse than a pandemic. So things got better. Then things were much, much better than people expected. So then everybody said things are worse. Right? But that doesn't mean, as it would historically, that there's necessarily a recession coming, because the amplitude of those...
I think there's definitely a realistic possibility that you're going to actually see ISM start going up at the end of this year, which is going to be, once again, another fascinating thing to happen in the market.
...and worse is so extreme. So I think we have to take that into account here. Now, your point that you just said a second ago, a year ago at this point, 90% of economists were saying we were either in a recession or one was imminent. I think that's down to about 40% now, roughly. Take or leave a little bit on that. And so, I do think that, a recession's looming out there. I don't see the point to trying to time it and say it's going to start next Thursday at 2:15 in the afternoon. I just don't think that's a fruitful investment strategy.
No, but what I'm trying to figure out, and maybe this was not a fruitful idea, but okay, I've got T-bills over here, at 4 or 5%, depending on, and then I've got the stock market, and I go, well, I know we don't always have to pick, but kind of which one's more attractive? Where's the risk reward looking greater?
Right.
For a while, It seemed like it was T-bills. And then
Right.
and then stocks ripped higher. And now you go, well, do you chase the market here after this move that we've seen? Or do you kind of pivot and go, well, maybe these yields are early? You know what I mean? That's what I'm trying to figure out.
Right. So I think there's two answers two questions in what you just said. One is cash.
Hold on, before we go further, okay? Here's something you need to always remember, okay? Very important with the financial markets. Wherever it looks like easy money's there, it's usually a trick of some kind, okay? And so if everybody thinks, oh, stocks are such easy money, it's usually a sign that probably things are going to head down shortly, right? When everybody thinks, okay, stocks aren't the play, we got to pile money into treasuries, it's probably a trick. Like almost every single time I've seen like consensus go to this is easy money, stay away from this over here, it usually leads to a situation where that ends up being wrong. And that's exactly like you were piling into treasuries the end of 2022 into the beginning of this year. You thought you were so smart, right? Oh, I'm getting out of these risky stocks. I'm putting my money in a safe, 4% place. I can get 4% of my money or whatever, right? And then you watch massive company after massive company, not even speculative companies, massive giant corporations, some of the most important, easiest stocks to buy in the market, fly 100%, 200% in 6 months. Stocks like Nvidia, Tesla, Meta, even stocks like Amazon have flown 50+%. These are the easiest stocks to buy, right? These aren't complicated. It's not like, I never heard of that business model. What do they do? Like, I've never used them before. Easiest stocks to buy. And people just missed out on doubling their money, tripling their money in a matter of months because the easy money was buying a treasury.
Attractive. And I think the answer to that is, of course it is. That's how the Fed imparts monetary policy on the economy. They try to disintermediate.
In 05, 06, everybody thought the easy money was real estate, right? Oh, just buy as much real estate as you can possibly get your hands on. We know how that played out, right? Obviously, end of 2020 into the beginning of 2021, oh, stocks are such easy money. Just buy any stock, and we know how that turned out. It's crazy, man. Every single time everybody thinks something's easy money now, and it's like becomes consensus around the entire population, it ends up proving wrong.
As much of the economy as they can. And so, of course, when the Fed wants to try to slow the economy, of course cash is attractive. I think it's unfortunate that investors fall in love with cash. You always have to remember you just date cash, you never marry it. But is cash attractive? Of course it is. And that's the Fed intent in
You always want to keep some cash around. I think that's an important point I need to make for everybody out there. Always keep some cash around. I like to be anywhere from 10 to 30% cash. 30% cash if I don't see any deals in the market and I'm like, dude, there's like nothing to buy out here. It's a tough situation. That's time to build cash. I'm a 10% cash when, let's just call it, there's a lot of good deals out there. And I've been on the lower side of cash for probably 12 to 18 months now at this point in time. Certainly the last 12 months, I'd say I've been on the lower range of cash. And the reason being is there's just been so many opportunities. At the second half of last year, growth stocks were disgustingly undervalued. It was easy money all over the place, right? At the beginning of this year. And now I'm finding a lot of opportunities in value stocks, dividend stocks, still a few growth stocks here and there, but a lot of values and divs are just super attractive. I appreciate everybody joining me as always. Thanks so much for being here, folks. Thanks for being subscribed, new all-time high subscribers. Get the free workshop I put together for you guys, how I find 10x stocks. It's a free, about 28-minute workshop, 29-minute workshop for you guys. That's going to be pinned comment down there. And make sure you learn a lot from that and enjoy that. Much love and have a great day.